Imagine a huge hydroelectric dam, like trillions of gallons of water just sitting there completely walled off in a reservoir. And below the dam, you've got all these fields that desperately need irrigation. But, well, whoever opens the floodgates to let the water flow gets hit with this immediate, steep financial penalty.
Right, so the operators just keep the gates closed. I mean, the water just sits there evaporating instead of actually nourishing the crops.
Exactly. And that structural bottleneck is exactly what Dr. Levne Moten targets in his position paper, The Unlocking Capital Act. Today, we're taking a deep dive into his proposal to, tweak the timeline of tax payments to basically open those floodgates. Because when we map this dam onto our economy, that water is your investment capital.
Yeah, and the penalty in this scenario is the realization year capital gains tax.
Right, the capital gains tax. So we have this enormous reservoir of capital. Why on earth should the tax code actively punish investors for moving that money to where it's actually useful?
Well, I mean, it shouldn't, but currently it absolutely does. What you're describing is what economists call the lock-in effect. Under current federal tax law, when you sell an appreciated stock, you generally face this enormous tax bill in that exact same filing cycle.
Which is a massive deterrent.
Huge deterrent. This structure heavily incentivizes you to just hoard your assets. Even if you spot, say, a better operating business or some promising new venture, the immediate tax price of selling your old stock creates a significant hurdle to reallocating your capital.
So how do we actually fix this bottleneck without starving the federal government of its necessary revenue? Because they still need that money.
By changing the timeline, not the total cost. So the Unlocking Capital Act doesn't rely on tax cuts at all. You still owe the exact same full amount.
Okay, wait, so you still owe the full amount, but
instead of demanding it all on tax day, you paid a fraction up front. And then the IRS essentially puts you on a 3-year installment plan with federal interest for the rest of the balance.
wait a minute. So it's essentially a buy now, pay later plan for the IRS. Why would the Treasury ever agree to just wait for their money?
Because the government is suddenly taxing sales that, frankly, simply wouldn't have happened otherwise. We're talking about tapping into an estimated $1.6 trillion in annual capital gains that are currently just frozen.
Oh, wow. So they're unlocking a totally stagnant pool of money.
Exactly. By triggering these new sales, the Treasury actually gets an immediate cash injection they otherwise wouldn't have seen. Plus, like I mentioned, they get to collect interest on those delayed payments.
Okay, so the government gets a revenue bump, taxpayers get liquidity, and the capital markets see a much more responsive reallocation of ownership. It basically directs the money to where it's most useful.
Right. It creates mutual benefits across the board. Everyone wins in this scenario.
But wait, what happens if the economy tanks? Let's say there's, I don't know, a flat upfront rate of 15%. If you force that kind of upfront tax bill during a recession, you're going to freeze liquidity entirely, right?
That is a great point. And it's exactly why the proposal introduces the Capital Activation Index. So the immediate payment rate isn't fixed at all.
Oh, it changes.
Yeah, it floats within a band of 5 to 15%, and it adjusts based on a live economic index. This index measures real-time data like GDP, labor market conditions, financial stress, inflation, and historical realization gaps.
Okay, let me make sure I'm getting this. So if the economy is crashing, the upfront hit shrinks to 5% to keep private money flowing and help investors stay liquid. But then, in a booming, highly inflationary market, it jumps to 15% to accelerate Treasury receipts.
Yes, precisely. And crucially, this is a mechanical, rules-based calculation. The Treasury just plugs the official public data right into the formula.
So nobody's just making up the numbers?
Exactly. It entirely prevents politicians or administrators from arbitrarily tweaking the rates to suit some political agenda.
That completely flips how we view tax policy. I mean, instead of a static wall-blocking investment, it becomes a dynamic valve that respects your financial flexibility and actually responds to the real-time health of the economy.
It really is a paradigm shift for how we treat capital mobility.
It's fascinating. But there is a final thought I want to leave you, the listener, with today. The Unlocking Capital Act specifically targets highly liquid assets, right, like publicly traded stocks.
That's right.
But if this pay-over-time framework successfully keeps capital fluid for those securities, could this exact same logic eventually be applied to heavily illiquid assets? Imagine applying this to real estate or an inherited private business. It could fundamentally reshape how all American wealth is taxed, finally opening the floodgates of that massive dam to let the capital flow to wherever it is needed most.